Did you know that your hard-earned savings are losing value every day they sit in the bank? Yeah, history has shown that prices of goods and services increase with time, thanks to inflation. So, as a consumer, you will spend more for the same things in the future. Case in point, a 2-liter bottle of Coke, which currently goes for $2.68 over at Walmart, was just 98 cents in 1998. Not taking risks or keeping your wealth in cash is a risk in itself. What you should do is invest wisely, so that your money increases in value as the cost of living also goes up. But what can you actually invest in? Hi, and welcome to Optimal Wealth, your ultimate destination for unlocking the secrets to financial independence and building lasting wealth. In today's video, I take you through the different forms of investing and how they work. Stick to the end as I reveal the worst investments you could possibly buy as a beginner. With that, let's jump into the video. First on the list is stocks. In the most basic sense, a stock is a fraction of ownership or equity an investor holds in a particular company. A unit of stock is made up of shares, the smallest unit of ownership. So if you buy 100 shares in Apple, then that is your stock in the company. Now, we can't cover everything about stocks in this single video, so let's answer 3 key questions you may have as a beginner. Why do companies issue stocks? How do you make money with stocks? And finally, where can you buy stocks? When starting a business, one of the biggest concerns is usually capital. You need money for the premises, equipment, inventory, and staff, among other setup expenses. Then, as the business progresses, you need more to expand or facilitate operations. If you don't have the cash flow needed, you can either borrow from banks or turn to the public. Corporations often source from the public by issuing stocks. And as the investor, you buy stocks hoping they increase in value as the company performs well, so you can make a return. Typically, there are 2 types of stock investors. We have the traders who buy and sell stocks frequently, taking advantage of small fluctuations in price in the short term to make a profit. Then there are the long-term investors who buy stocks not to trade but grow wealth in the long haul. Some stocks also pay out dividends. These are company profits that are periodically shared among equity holders. Now, stocks are listed, bought, and sold in regulated marketplaces known as stock exchanges. All in all, stocks have the potential for high returns, but they also come with a higher level of risk than most of the other forms of investing we will discuss in this video. Next up, we have bonds. It is not just businesses that turn to the public to raise money. Governments, too, do this. But instead of stocks, they issue bonds. A bond is a fixed income security issued by governments and sometimes corporations to investors. Now, think of bonds as a loan you give the bond issuer. It comes with a fixed interest rate, the income you will earn once or twice a year, and a maturity date upon which your money is paid back. So you don't own a percentage of the corporation or government agency. As an investor, you can buy and hold bonds until maturity, pocketing the regular interest. Or you can buy and trade your bonds in a secondary market to turn a profit. Generally, bonds are low risk and give you decent returns. No doubt stocks and bonds are the most popular investment vehicles. So what if you could combine them in one product? Well, that is exactly what the next 3 investments, collectively known as funds, do. Mutual funds. A mutual fund is a pool of investor money spread out across various securities, including stocks, bonds, and other assets, and managed by a professional money manager. The fund manager decides where to invest the money to generate returns for the fund's shareholders. Mutual funds are great because they spread out risk by combining a variety of assets. This feature makes mutual funds more realistic and affordable when you want diversifying your portfolio. However, because it is actively managed, the expense ratio can be pretty high. Next up, index funds. An index fund is a type of security that tracks components of a particular market index, for example, the S&P 500. It matches the benchmark index's performance regardless of what's happening externally in the market. Like mutual funds, you get to diversify your portfolio as your money is invested in all the companies within the benchmark index rather than just one. However, all index funds are passively managed, which translates to lower management costs for the investor. So, is investing in an index fund good? The world's most successful investor, Warren Buffett, thinks it's a great way to save for retirement. Lastly, we have exchange-traded funds. Exchange-traded funds, or just ETFs, are baskets of securities bought and sold in open exchanges. They are similar to index funds in many aspects, including passive management. However, they are traded like stocks throughout the day, while index funds and mutual funds are traded at the closing price at the end of the day. ETFs are generally friendly for individual investors because they have lower fees, are more tax efficient, and can be easily traded. Aside from funds, you can also invest in retirement plans. If you don't have a retirement plan, it's time to get one. It is one of the best ways to build a nest egg to sustain you when you can no longer work. So you make regular contributions from your income, which are then invested in market assets such as mutual funds. Your contributions grow tax-free until you are eligible for withdrawals at 59 and a half years. A retirement account is either a 401k, provided by the employer, or an individual retirement account, IRA, which you set up yourself. Now, up until this point, we have covered investment products around stocks and bonds, but they are not the only way you can invest your money. You can also look at high-yield savings accounts, CDs, and money market accounts. You will be surprised to know that local banks actually have a couple of investment products you can explore. This includes fixed deposit accounts, money market accounts, which are similar to fixed deposit accounts but with higher balance requirements and better interest rates, and certificate of deposit, where you are basically loaning the bank money. These forms of investing are very low risk. However, low risk also means low reward, and you will need more than this to actually build wealth. Real estate and real estate investment trusts. If you have a significant amount of money, you dip your toes in the real estate market. Property investment is capital intensive, but if you can find the right properties, you can actually make decent returns. Typically, you want to buy properties for below market rates and resell for the full amount. Now, if you still want a slice of the real estate market but don't have the needed capital, investing in a real estate investment trust, or REIT, is a good place to start. Basically, these trusts pool together investor money and buy rental properties. Then they distribute the income these rentals generate as dividends to investors. With an REIT, you can actually own a fraction of the property. And finally, precious metals. Gold, silver, palladium, and platinum are the most common precious metals in the investor market. Investing in precious metals is widely seen as a great way to protect wealth when currencies and markets are shaky and unpredictable, rather than a way to actually multiply wealth. So where can you buy them? There are licensed precious metals distributors and exchanges all over the world. What should you keep off as a beginner? Now, investing in itself is a risk, and whatever you pick, you are going to take on some risk. But as a beginner with a relatively low-risk appetite, you want to stick to retirement accounts, mutual funds, index funds, ETFs, bonds, and a bit of stocks in solid companies. You want to avoid penny stocks. These are stocks from small companies that trade at less than $1. They are super volatile, illiquid, and prone to manipulation. Single stock or bond. No matter how attractive a stock, bond, or other security looks, don't throw your diversification out the window. Hottest pick. That company that is rumored to be the future Amazon or Apple will probably cost you money if you don't do research. Whole life insurance. Looks good at face value, but the returns are often terribly low. Savings accounts with average APY. Traditional savings accounts are notorious for paying out low APYs, usually less than 1%. 3x ETFs. Leverage in investing is where you borrow in a bid to amplify your returns. Triple leverage ETFs increase your risk tremendously, especially in the long term. That brings us to the end of today's video. To sum it up, in the words of Shelby Moore Collum Davis, a retired investor and money manager, invest for the long haul. Don't get too greedy and don't get too scared. So, what investment products have you tried? What can you add to the list? Drop your comments below. Don't forget to like the video and subscribe for more financial literacy videos like this every week. Bye.